I usually work at my office there too. But since I'm downtown, I thought I'd stop
You can watch that discussion in its entirety online at the C-SPAN Video Library. We'll be going shortly live to the Federal Reserve Chairman Ben Bernanke, who's in Massachusetts today to address the 55th Annual Economic Conference. He'll be talking about monetary policy and the U.S. economy at the Federal Reserve Bank of Boston. Of interest, any clues as to what actions the central bank might take to help boost the economy. This conference comes before the next meeting of the Fed's Open Market Committee, which sets monetary policy, and they're going to be meeting on November 2nd and 3rd. One of our first speakers at the conference, we expect to hear from Federal Reserve Bank of Boston President Eric Rosengren. We'll be going to that live shortly, right here on C-SPAN 2. Coming up at 9 Eastern, a discussion on the children of immigrants in America from the Urban Institute. And on our companion network, C-SPAN, the Center for Strategic and International Studies hosts a conference on the Year Ahead in Space policy. We'll be bringing that to you live at 10 o'clock this morning Eastern. And you're looking at the room here from the Bank of Boston and expecting to hear momentarily from Federal Reserve Chairman Ben Bernanke. This is live coverage on C-SPAN 2.
Didn't even have to quiet people down. So welcome to the first day of our conference. This is actually the maiden voyage for this room. 6 months ago they told me we were going to be able to have this room on time for the conference. 6 weeks ago people were quite pale as they were talking about whether it would be on time and on schedule. And fortunately 2 days ago they assured me it was going to be ready, and indeed it is. So I'm very pleased to be able to have the conference in a new conference room. As Paul Conley mentioned yesterday, one of the main advantages of having a regional Fed system is that we're able to convene people throughout the country to discuss important topics. And I think this room is one of many rooms that we use in the building to actually bring people together from all over New England to talk about the types of topics that we're talking about today. So I'm very pleased that we have this facility to go ahead and do that. This conference revisits an issue that was addressed actually 11 years ago in October of 1999. The topic was monetary policy in a low inflation environment, and we've only added the revisited to the title to reflect the fact that the topic is just as important today as it was 11 years ago, and in fact arguably even more important. Now, retrospectives can be quite challenging because with the passage of 11 years you never know quite what you're going to actually find and what you're going to learn over that 11-year period. So I was thinking about retrospectives, and one of the things that I think of when I think of retrospectives is sometimes it works out well, sometimes it doesn't work out so well. So when I turn on the TV and the retrospective is focused on child actors, and they say, where are they 15 years or 20 years later, I normally rush to turn the TV off or change the channel. So my hope is that over the course of these 2 days, we're not there to try to turn off the channel, but instead I think for economists with the passage of time, it's a little bit closer to red wine, that passage of time actually benefits the product. Economists seem to think that more data is better, and we've certainly had 11 years of very interesting data to be analyzing a topic for this conference. Many of the participants at this conference were here 11 years ago, so if you look at our proceedings from that occasion, you'll see that we have a number of people that are on both panels and in giving papers. So I welcome those people back to reflect on what they've learned over the 11 years. I would say overall that my own assessment is that we got a lot of the issues about right. A lot of the issues in that volume really did highlight some of the problems. I would also say, though, that there's certainly things that we've learned in the process, so it's not as if we haven't learned anything with the passage of time. And I think you'll hear that throughout the day. One of the speakers that was here 11 years ago was the chairman. He was here in a different capacity. At that time, he was a professor at Princeton. He was already world-renowned for his research on the Great Depression, monetary policy, understanding how banking problems could spill over to the real economy. And he contributed as a discussant at that conference. We've been very fortunate that we've had the chairman over the last 3 years, a particularly difficult time period for the country as a whole. But I can't think of any person who's more qualified to talk about the challenges facing us and how to conduct monetary policy in a low inflation environment than Chairman Bernanke. So, Chairman, please.
Good morning. The topic of this conference, the formulation and conduct of monetary policy in a low inflation environment, is timely indeed. From the late 1960s until a decade or so ago, bringing inflation under control was viewed as the greatest challenge facing central banks around the world. Through the application of improved policy frameworks involving both greater transparency and increased independence from short-term political influences, as well as through continued focus and persistence, central banks have largely achieved that goal. In turn, the progress against inflation increased the stability and predictability of the economic environment and has contributed significantly to improvements in economic performance, not least in many emerging market nations that in previous eras had suffered bouts of very high inflation. Moreover, success greatly enhanced the credibility of central banks' commitment to price stability, and that credibility further supported stability and confidence. Retaining that credibility is of utmost importance. Although the attainment of price stability after a period of higher inflation was a landmark achievement, monetary policy making in an era of low inflation has not proved to be entirely straightforward. In the 1980s and 1990s, few ever questioned the desired direction for inflation. Lower was always better. During those years, the key questions related to tactics. How quickly should inflation be reduced? Should the central bank be proactive or opportunistic in reducing inflation? As average inflation levels declined, however, the issues became more complex. The statement of the Federal Open Market Committee, following its May 2003 meeting, was something of a watershed in that it noted that in the committee's view, further disinflation would be, quote, unwelcome. In other words, the risks to price stability had become two-sided. With inflation close to levels consistent with price stability, central banks, for the first time in many decades, had to take seriously the possibility that inflation can be too low as well as too high. A second complication for policymaking created by low inflation arises from the fact that low inflation generally implies low nominal interest rates, which increase the potential relevance for policymaking of the zero lower bound on nominal interest rates. Because the short-term policy interest rate cannot be reduced below zero, the Federal Reserve and central banks in other countries have employed non-standard policies and approaches that do not rely on reductions in the short-term interest rate. We are still learning about the efficacy and appropriate management of these alternative tools. In the remainder of my remarks, I will discuss these issues in the context of current economic and policy developments. I will comment on the near-term outlook for economic activity and inflation. I will then compare that outlook to some quantitative measures of the Federal Reserve's objectives, namely the longer-run outcomes that FOMC participants judged to be most consistent with its dual mandate of maximum employment and price stability. And finally, I will observe that in a world in which the policy interest rate is close to zero, the committee must consider the costs and the risks associated with the use of non-conventional tools when it assesses whether additional policy accommodation is likely to be beneficial on net. The arbiters across the river in Cambridge, the Business Cycle Dating Committee of the National Bureau of Economic Research, recently made their determination. An economic recovery began in the United States in July 2009, following a series of forceful actions by central banks and other policymakers around the world that helped stabilize the financial system and restore more normal functioning to key financial markets. The initial upturn in activity, which was reasonably strong, reflected a number of factors, including efforts by firms to better align their inventories with their sales, expansionary monetary and fiscal policies, improved financial conditions, and a pickup in export growth. However, factors such as fiscal policy and the inventory cycle can only provide a temporary impetus to recovery. Sustained expansion must ultimately be driven by growth in private final demand, including consumer spending, business and residential investment, and net exports. That handoff is currently underway. However, with growth in private final demand having so far proved relatively modest, overall economic growth has been proceeding at a pace that is less vigorous than we would like. In particular, consumer spending has been inhibited by the painfully slow recovery in the labor market, which has restrained growth in wage income and has raised uncertainty about job security and employment prospects. Since June, private sector employers have added, on net, an average of only about 85,000 workers per month, not enough to bring the unemployment rate down significantly. Consumer spending in the quarters ahead will depend importantly on the pace of job creation, but also on households' abilities to repair their financial positions. Some progress is being made on this front. Saving rates are up noticeably from pre-crisis levels, and household assets have risen over recent quarters, while debt and debt service payments have declined markedly relative to income. Together with expected further easing in credit conditions and terms offered by lenders, stronger balance sheets should eventually provide households the confidence and the wherewithal to increase their pace of spending. That said, progress has been and is likely to be uneven, as the process of balance sheet repair remains impeded to some extent by elevated unemployment, lower home values, and limited ability to refinance existing mortgages. Household finances and attitudes also have an important influence on the housing market, which has remained depressed, notwithstanding reduced house prices and record low mortgage rates. The overhang of foreclosed properties and vacant homes remains a significant drag on house prices and on residential investment. In the business sector, indicators such as new orders and business sentiment suggest that growth in spending on equipment and software has slowed relative to its rapid pace earlier this year. Investment in non-residential structures continues to contract, reflecting stringent financing conditions and high vacancy rates in commercial real estate. The availability of credit to finance investment and expand business operations remains quite uneven. Generally speaking, large firms in good financial condition can obtain credit in capital markets easily and on favorable terms. Large firms also hold considerable amounts of cash on their balance sheets. By contrast, surveys and anecdotes indicate that bank-dependent smaller firms continue to face significantly greater problems in obtaining credit, reflecting in part weaker balance sheets and income prospects that limit their ability to qualify for loans, as well as tight lending standards and terms on the part of banks. The Federal Reserve and other banking regulators have been making significant efforts to improve the credit environment for small businesses, and we have seen some positive signs. In particular, banks are no longer tightening their lending standards and are reportedly becoming more proactive in seeking out creditworthy borrowers. Although the pace of recovery has slowed in recent months and is likely to continue to be fairly modest in the near term, the preconditions for a pickup of growth next year remain in place. Stronger household finances, a further easing of credit conditions, and pent-up demand for consumer durable goods should all contribute to a somewhat faster pace of household spending. Similarly, business investment in equipment and software should grow at a reasonable